Warren Buffett just bought 5 million shares of UnitedHealthcare Group, the largest single health insurer in America, which has just recently been covered in controversy and failure. We are going to dive into why the health insurance industry has been struggling so much in the last 10 months, and then at the end of the video address, would I consider buying new shares of UnitedHealthcare Group? Before we dive deep into the issues with UnitedHealthcare Group, we need to first understand how the business works and where UnitedHealthcare Group makes the majority of their profit. We have two major business segments, the first being the namesake of the company, UnitedHealthcare, which is the health insurance arm of the business. This insurance is broken up further into three groups, with 23% of revenue coming from employer and individual insurance, 50% from Medicare and retirement, and 27% from government workers. Altogether, you could say the Medicare and government contracts, which make up 77% of insurance premiums, they are negotiated directly by the government. So therefore, if you have state and federal governments which are really struggling with their budgets and trying to get down government spending, this is going to have an extremely large impact on UnitedHealthcare Group. And the second half of the business is Optum, which again has about a quarter of the profit coming from healthcare plans. Optum has 1/4 of profit coming from Insight, which is health analytics and data. Now, they also help drive down costs for the company, but they can also sell those services to other people. And finally, we have half of Optum's profit coming directly from pharmacy. The far majority of the health insurance arm is coming from the government, and being the biggest buyer, they are likely setting the price rates for the entire industry. And with the extensive political pressure from both the left and the right, health insurance companies don't really have any allies. Things have changed really drastically in the last 6 months across pretty much every health insurance company. For example, here, UnitedHealthcare Group insurance arm, they had profit margins collapse 61.3% just in the last 3 months. If we go back to 12 months ago, that profit margin is down 55.6%. Whenever I look at a company that has declining profit margin, I roughly put them into two different groups. The first group is those that have struggling revenue growth. Their costs of the business are maintained, it's just your revenue is going down. That's always going to squeeze your profit margins. Now, the types of companies in that situation would be food-related companies over the past year. Think of your General Mills, your lower quality packaged food companies. They are really struggling to grow revenue, and the profits are declining in 2025. In a sense, the first group of companies, the fix is quite simple. You just need to do whatever you can to increase your revenue. That could be easier said than done, but at least the fix is simple. UnitedHealthcare Group actually sits in the second camp. That's the camp where you have very healthy revenue coming in, but there's something wrong with your fundamental business and why you can't maintain profit. In a sense, health insurance companies are pretty easy to analyze because they have one really important metric and everything else flows from that. We have something called the medical cost ratio. Think of this as a payout rate. You have customers that pay their health insurance premiums, and then UnitedHealthcare Group is meant to pay out money to help fix people's medical issues. At the moment, that ratio is sitting at 89.4%. And just to show you how bad that is, it's an absolute catastrophe, I'm going to show you the medical cost ratios for the second quarter of every year, going back the last 12 years. And you see here the ratio is very consistent, pretty much dead on 82.5%. There's only 1 year in history that is abnormal. That was 2020 when everyone stayed home and UnitedHealthcare Group kept charging people their insurance premium. They had a very low payout ratio, meaning they kept a lot of profit. But focusing just on 2025 for now, the 89.4% cost ratio is a full 5.9 standard deviations higher than the usual average, or in other words, it's a 1 in 550 million probability event. So that's telling us directly that something fundamental and large has changed in the company and the way they do business. Now, they've tried to pin that on people going back to pre-pandemic behavior, but as you could see from that graph, and why diving in deeper is so important, we've been going back to pre-pandemic levels really since 2024. I think there's something bigger going on, and we're going to spend the rest of this video trying to figure out what that is. This makes me extremely concerned as an investor, and we would have to see UnitedHealthcare Group really look into two key fixes in how they could increase their profit margins, and the first one is trying to convince the government to spend more money. As we said before, about 77% of all health insurance at UnitedHealthcare Group is priced by the government. And if we want to see higher profit margins for United, we need the government to come up and pay more money and actually pay more than what medical costs are growing. That's probably going to be difficult when we've had the big beautiful bill just get passed, and that means we are likely to see $715 billion worth of funding of Medicaid get cut over the next decade, and $335 billion of additional cuts get cut from pretty much Obamacare. People might disagree, but I think 2025 is going to be a standard year, pretty typical of what we could expect in the next decade in terms of healthcare costs. And we have recently seen a 8.5% year-over-year increase in healthcare expenses. However, for the broad industry, health insurance premiums are only expected to grow 4.5% annually from 2025 to 2033. Therefore, if you're interested in UnitedHealthcare Group, this is an absolute disaster, really. You're seeing both your opportunity for revenue go down or just not grow that strongly. However, your costs are going up about double that rate. The first concern was all about the broader industry and pretty much forcing profit margins lower. The second concern is more about a self-engineered failure, all to do with avoiding political pressure and pretty much just hatred from the American people. It's all centered around Brian Thompson, the CEO of UnitedHealthcare Group last year, and how he was ended by Luigi Mangione. Some people speculate this has placed a magnifying glass on people looking directly at the health insurance industry, but also UnitedHealthcare Group in a lot of extra detail and scrutiny. And only a few months later, that's when we started to see the 60% collapse in the profit margins of these health insurance companies. People are calling this the Mangione effect, that his actions, kind of sacrificing himself, has actually led to these health insurance companies paying out some extra cash to people to pay for their health problems. And this is the big question for investors in UnitedHealthcare Group. They potentially have this rebound effect that could happen over the next couple years. If this is just a short-term hiccup, then we could expect to see profit margins rebound 150% to get back to early 2025 levels. This is showing the 12-month P ratio going back into recent history and just gives us an idea of what's a good valuation to pay for UnitedHealthcare Group. Now, during normal times, I would say around an 18 forward P ratio or even a 20 could be considered cheap for this usually darling of the stock market. However, with all the controversy and the strong sell-off, we got down to forward P ratios below a 15. After the news of Warren Buffett coming out and buying UnitedHealthcare Group, that just really took away an opportunity to buy the company for a cheap valuation, making the company actually not that cheap, even though the company is still down about 50% from all-time highs, just over a 50% drop. In order to justify buying the company at today's prices, we would have to expect decent profit growth, earnings per share growth of at least 20% moving forward. Again, that is slowly reinflating that profit margin back to early 2025 levels over a course of about 4 years. And flicking over to the growth on sale portfolio, where my strategy is simply buying up darlings of the stock market, large cap companies, when they go on sale, but their growth in the future is still healthy. Now, I do have a position in UnitedHealthcare Group, but I don't plan on buying really any more at these prices. But now that we've jumped up so much in a short period of time, I'm happy just to wait and see how this plays out.